Okay, good morning, and I'm sorry for the short notice on doing this review, but I had a brief, about an hour worth of space here, so I wanted to utilize it as best I could. And so what you're looking at is the examination for the midterm. And so I'm just going to go over very quickly some of the items to give you an idea of how many and what you should be looking for in terms of your midterm examination. So if you look at the first 6 questions, those are all based on payroll. So what you're going to be asked to do in most of these questions is you're going to be asked to either compute the taxes or you're going to be asked to understand that there is a limitation that's placed on Social Security. And so what I mean by the limitation is that Social Security, or OASDI, is composed of really 2 components. The first is your Social Security or old age survivor and disability insurance. And the second part is Medicare. The old age survivor disability insurance side, the Social Security side, has a limitation of, I think, 128.7. Don't quote me on that, but that's pretty close. And so what that means is that once you have reached that number, and of course, any problem that we give you will tell you what the limitation is. They won't have you guess at it, but they'll tell you what the limitation is. And most of these questions, by the way, they don't reach the limitation, but I want you to know that once you reach the limitation, the taxation for Social Security stops. That's different than the taxation for Medicare. Medicare, if you made $100 million or $1 billion or whatever the case might be, you're going to pay that Medicare portion on that entire amount. Social Security is different because Social Security has an absolute limit in terms of the amount of Social Security that you can earn monthly. So they stop this at around 128.7 or so. Okay, so that's one limitation. There's another couple of limitations that you find as well, and those have to do with your state unemployment tax insurance and your federal unemployment tax insurance. And typically, those max out at $7,000. Now, those are paid not by the employee, but by the employer. So they become part of employer taxes. So you want to make sure you understand the difference between what the employee pays and what the employer pays. So the employee, if you look at one of their gross, one of their paychecks, they'll start out with a gross number. And this is just for argument's sake, let's just say that they made $20 an hour and they worked 40 hours that week. So they would have a gross pay of $800. Now, on that, they're going to be charged some federal income tax. And whatever the case might be, they would tell you what that amount was. They won't have you compute that. But whatever it is, $80, say. And then in addition to that, they're going to have you pay, as an employee, you'll have to pay Social Security tax. And that Social Security tax is around a little bit over 6%. And then you'll pay 1.45% on Medicare. In addition to that, you may have things like health insurance that you're having withheld, life insurance, a Christmas club, union dues. There are a plethora of things that are menu items that you can have removed from your paycheck. 401k is a good example as well. Now, the company has a fiduciary responsibility to you to accumulate those amounts and then pay them to whichever agency it happens to fall under. So if it's federal income tax, then it's paid to the federal government. Of course, if it's state income tax, it gets paid to the state government. If it's your 401k, it gets paid to whatever provider you have of your pension plan, whoever your manager of the pension plan is. So, and of course, health insurance and life insurance works the same way. Whoever the provider is will get that money. when I say that the employer has a fiduciary responsibility, that means that they have the responsibility of accumulating that money and then paying out that money to the to whatever provider. And then what's left will be your net pay. Now, on the employer side, the employer does not pay any federal or state income tax for you, but the employer does match your Social Security and your Medicare. The employer also pays, as I mentioned before, any state unemployment tax and any federal unemployment tax that's due. Now, the federal unemployment tax can be a little bit tricky because it's 6.2%, but it doesn't really work that way, because what's going to happen is you're going to pay around 2.7% to your state. And so the federal government says, well, whatever you paid to the state, plus we'll match whatever you paid to the state. So they would match the difference, which is 2.7 and 2.7. So now if you paid your state unemployment tax on time and everything, now you get a 5.4% reduction in your federal unemployment tax, leaving you with 0.8%, which is a very small number to pay to the federal government for FUTA, or federal unemployment tax. So that is basically what you're going to see on your on these first 6 questions. Okay, after that, we have a few questions, and not an awful lot, but it's going to run down to, in this case, I think right around here. So you're going to have questions 7 through 14. So about 7 or 8 questions on long-term investments and that sort of thing, bonds and like that. And usually I tend to look at both the controlling aspects of these investments and what constitutes control and how you account for that control. So you have, if you have less than 20% ownership, if you have less than 50% ownership, or between 20 and 50, if you have over 50% ownership, those are all handled in different ways from an investment perspective, how you do it on the balance sheet. So you want to take a good long look at that. Ratios, I'm always big on ratios, and I think that as I remember, there are about 4 ratio calculations on your midterm examination. When a bond sells at a premium, well, what does that mean? Okay, what is the premium? Well, that's more money than the face value. So if the face value is 100% or $100, then if it's selling for a premium, it might sell for 102, okay, or $102 per 100. And what that means is that the interest rate that is offered on that bond is higher than the interest rate on comparable bonds. So if the market has an interest rate of 6% and all of the bonds that are available that are comparable, that are same type bonds in the marketplace, those bonds are selling at 6%, your bond is selling at 7%, then that is paying 7% interest, then since the interest rate is higher and they're comparable bonds, you're going to demand a premium for it. Now, the same thing would be true in reverse. If your bond is selling at a discount, that means that those roles would be reversed. The market is for comparable bonds is about 7% interest, and your bonds are trading at 6%. So they're paying less amount of money in terms of interest. So why would anybody buy them? They wouldn't buy them unless they can buy them at a cheaper value to make up for that shortfall in interest. So, and then how you handle it, of course, is essentially it's going to be straight line amortized. That premium or that discount will be straight line amortized. And it becomes additional interest expense, or it becomes a reduction in interest expense, depending on whether it's a premium. That'd be the reduction in interest expense. or a discount, that means your interest expense is actually rising. So take a close look at those, and that'll tell you what you need to do with that section of the examination. Now, the last section of the examination here is on the statement of cash flows. And as you probably can guess, this one is one that I told you is very important. And if you look down through here, you can see that question after question after question has to do with the statement of cash flows. So when preparing the operating activities section, okay, that's an example, operating activities, that's the first section of the statement of cash flows. And on that statement, what you're going to see is net income and then changes to assets and liabilities, current assets and current liabilities. And so those kind of things will give you the statement of cash flows. Financing activities are the last portion of it, because there's a definite pecking order. The first part is cash flows from operating activities, and then you have cash flows from investing activities, and finally you have cash flows from financing activities. So operating activities are just what they're talking about. These are your operations of your company. And so, for instance, your sales and your net income that arises from those sales. You have whatever sales, and then you have the cost of sales and all your expenses and so forth. And you come down to the bottom and you have net income, and that's the starting point for the statement of cash flows under the indirect method. Well, you start off with cash, whatever the cash balance previous year is, and then you go into net income and so forth. So let me just talk about some of the areas of interest and importance in this statement of cash flows. The first is that you start with net income, correct, but what about depreciation or amortization expense? Well, both of those, depreciation, amortization, those are non-cash expenses. However, they are coming out of your net income. So we add them back in on the statement of cash flows. So you would see, for example, your net income, let's say depreciation was 100,000 and net income was $1 million. So you'd have net income of $1 million plus the depreciation of 100,000, and then you would go from there. Now, in addition to that, you're going to be looking at how the current asset change, how current assets change. So, for example, if accounts receivable goes up, cash flow goes down. And the reason for that is really kind of simple if you think about it. Accounts receivable represents you're waiting to be paid. So you have two choices here. Either you could be paid immediately for something you sold, or you could be paid in the future for something you sold. And so if you're getting paid in the future, as the case of accounts receivable, and so accounts receivable is going up, then your cash flow is going down, because the alternative is that you would have collected the cash. Okay? Now, by the same token, if accounts receivable is coming down period to period, all right, so I had $10,000 worth of accounts receivable in the previous period, and now at the end of this period, I only have $8,000 worth of accounts receivable. That means my accounts receivable went down by $2,000. Think about the entry that would make that happen. It would be a debit to cash. So cash is going up, accounts receivable is going down. Okay? So if your receivables are falling period to period, and that is from the first period to the second period, the end of this year is the second period, then your cash flow is going up. If it's rising from last year to this year, then your cash flow is going down. All right. Now think about the other side of this, the liability side, and accounts payable. Accounts payable is different in the sense that you have two choices again. So I go down and I buy something. So I can either pay for it right then, that means cash is going out, or I can charge it. And if I charge it, that means that I did not pay the cash out. So therefore, if accounts payable is going up from the first period to the second period, that is a source of cash. That is, cash is coming in. If it's going down, that means that I had to pay more cash out. So that's a use of cash. So just kind of think about that. Any payable that goes up is going to create cash. Any payable that comes down is going to use cash. Any receivable that goes up is going to use cash. And any receivable that goes down will be a source of cash. Okay. The next section is investing activities. And sometimes it's confusing because when we think of investing activities, we might think of bonds and stocks and so forth. Well, there is an involvement of that, but in a different way than what you probably think. So I'll put that on the back burner just for a second. Let's just talk about investing activities in the general sense. So investing activities have to do with if I buy stock in another company, okay? I'm not talking about my own stock now. I'm talking about our company stock. I'm talking about stock in another company. Well, that's an investing activity, okay? And if I buy it, then the cash is going down. And if I sell it, cash is going up. By the same token, when they think about investing, they're thinking mostly about the purchase or sale of long-term plant assets. So for instance, land or a building, those kinds of things. So if I buy a building or if I buy a new automobile, that represents a use of cash. Cash is going out. If I sell it, that represents a source of cash. So if I have, for example, I sell a building that has a book value of $50,000 and I sell it for $50,000, then my cash goes up by $50,000. Okay. By the same token, if I bought a new building at $250,000, then my cash goes down by $250,000. So those are the investing activities. The financing activities, this is how you finance your business. Well, you can finance a business either through debt instruments, that is bonds, those kind of things, or you can finance your business through equity instruments. So I sell my own stock, okay? And so in those cases, if I'm selling a new bond, all right, so I'm going to finance with debt, I have cash coming in, so that's a source of cash. If, on the other hand, I purchase, if I pay off a bond, this is a better way to look at it. If I pay off a bond, that's a use of cash. In terms of the stocks, if I put new stock out in the marketplace and they're purchased by investors, then that is a source of cash. If I buy my own stock back up and put it in the treasury, that would be a use of cash. Okay, so you want to take a look at things like the gain or loss from retirement of notes payable, what happens to that, how you deal with that. And then again, operating activities, refer to the following selected financial information. It's going to talk about those kind of activities. Same thing there. And then this is probably, let me back up here. Let me just take a quick look at this one because I think probably that is, compute the asset test ratio. Yeah, there you go. Okay. You know, so now they're giving you, so this is the financial statement analysis section here from about 31 on down. Now, you won't see them in this order because I shuffle all these questions, but you'll see them in some sort of a randomized order when you see them, but all of these questions will actually be there. So what you're looking for, in this case, the asset test ratio is a ratio that indicates your ability to pay your bills. And they call it an asset test ratio because it takes your current assets and takes out of the current assets any inventories or prepaids. So you're looking at just your most liquid assets, your cash, your marketable securities, and those sorts of things, accounts receivable. Those are the kind of things that are included in that. But just think about it in terms of I've got to take out the inventory and I've got to take out any prepaids, and that usually will answer about 90% of these questions. And then, of course, it's the current assets minus those two items over current liabilities. That gives you the asset test. The current ratio is simply all of the current assets, including inventories and prepaids, over current liabilities. And so down here, you're going to see net sales divided by average total assets. That's another ratio. I'm not going to tell you about it. I want you to read it and kind of know what we're talking about. And that's probably the same thing here. Let's see here. When I see use the following from selected information from Whitmer, I suspect that that's another ratio. All right. So look very carefully. This is another ratio. Dividing net accounts receivable by net assets. What is that going to be? Well, that's going to have something to do with either the days in receivables or receivable turnover. And there's an easy way to compute this. If I stop for just a second and say to you that if I determine that the days in receivables are 30, okay, so I have 30 days, and so that means from the time, on average, from the time that I sell something on credit until the time that I collect it, 30 days have elapsed. And by the way, 30-day terms, that's standard terms. So if that's the case, then think about it for a second. How many 30-day periods are there in a banker's year of 360 days? Well, there are 12. So that means that I'm turning my asset accounts receivable over every month or 12 times per year. So once you have one of those, you can easily calculate the other one from that. If I know that, for instance, if I'm turning it over 12 times a year, then I know that that's going to be every 30 days that I'm turning it over. Okay, so again, what you're looking at here are every single question. I'm not going to change any of these questions, but I'm going to shuffle them so that you don't see them in the same order. So you can't just look down and say, well, this is what it is from this video. And so that actually takes care of this particular thing. We only had 40 minutes anyway, but that takes care of this review. So we have 5 or 6 questions that are from the payroll side, the first of these chapters, and then you're going to have a few questions from investments. You're going to have a good number of questions from cash flow. That's probably the most important of those areas. And then another good number of questions coming from the last chapter, which has to do with the financial ratios and understanding how the financials go together. So I think that is it's a pretty good indication to you of what we're going to do on the midterm, and I hope that it's helpful for you. And that's it. So thank you very much for your attention, and I will see you later.